Morning. Morning, guys, for Zoom. Today we're going to talk about reverse mortgages. I asked Pulido, one loan officer called me this last week, and he says, do you know anybody who does reverse mortgage? And I went like, wow, I mean, we do. Obviously, we have told you in the past that if you have a reverse mortgage, talk to Pulido, because Pulido has a very good relationships with the investors, and Pulido knows the first screening that he has to do. So he's going to talk to you about the screening, things to look for, the equity, the FICO scores, the income. You can discuss it with Pulido, but also if you want to see it on the first hand and just say, well, if it doesn't meet these guidelines that Pulido is saying that they're global, he's not going to qualify, or the persons are not going to qualify, or they will qualify. So bring every case to Pulido. Pulido has a questionnaire. I believe, but I might be mistaken, that he has some types of formulas also that they can calculate. They can calculate whether he qualifies or don't qualify. Before I give the microphone to Pulido, is there any questions, comments? If there are no questions, comments, so let's give a round of applause to Mr. Jose Pulido.
What excitement, oh my goodness. Look at the level of excitement this morning from everybody. Okay. Let me see, oh, well, it does. Reverse mortgage. So just the basics first, just until you guys wake up. A mortgage meaning in itself, it means that you have a loan that has a life expectancy. That's a mortgage. The word mort, that means it's going to die. You have a loan, and eventually it's amortized, so it means it's going to die. Okay? So the opposite, reverse mortgage, that would be a loan that it's not going to die. It's going to outlive. It's going to outlive your borrower. Okay.
Never thought about it like that.
Okay. So I mean, when your borrower dies, the loan is still there. That's why it's reverse mortgage. On the contrary, since it's reversed, not only does it start at a certain amount, it will just keep increasing. That goes into what's called negative amortization. So that's one of the first things to keep in mind. Negative amortization means it's like a tumor. Okay, if you don't get it taken care of, it's just going to keep growing, right? So, but maybe that wouldn't be a good selling point to your borrower. Let me get you into a tumor where you're going to get cancer eventually. But anyway, so that's a reverse mortgage. Just the sound of it scares a lot of people off, but there is a certain group that it could be like a lifesaver for them, and this group it's only targeted for a certain group of borrowers, and this would be your senior citizens, normally people who are retired, who have a home, either all paid off or even if they still have a mortgage, but they have a lot of equity in the property. And that's what it's designed for. So one of the main requisites, would be that you need to be 62 or over to qualify. Okay. So, in addition to 62 or over, there really is, there's, I know Oscar mentioned that I have formulas, but I don't. There isn't a formula for this one. What we do is with the two investors that we work with for the reverse mortgages, one, we would get the basic information submitted to them, and they give us a quote based on that information as far as like how much the borrower will qualify for. The other one, we could just, if you sign up with them, we could input the information ourselves and get the quote instantly. So now I'll go into, let's see, well, is it worth it? How does it compare to a regular mortgage? How do we get paid? So in that essence, because there's a lot of misconceptions and stuff about the reverse mortgage. I've heard from second-hand information that reverse mortgage, people make a killing on that because it's not regulated as far as like the points that normally here. A normal loan, we're capped at 3% of total costs and fees to the borrower because these are TRID loans. Now, a reverse mortgage would not fall into that. So there is, I believe there's a little more, I don't know how much. Someone said, oh yeah, someone's making like $50,000 in commission on each, but that seems a little far-fetched and I haven't seen it, but when we get to the loan amounts, I'll tell you how they calculate it. But it can be either just the same or maybe a little bit better than a regular loan, and they're not really that hard to qualify for. I mean, if you have the basic, if your borrower meets the basic requirements, then it's not, you're not going to be dealing with a lot of conditions that relate to income. Okay, let's see, and the loan officer who asked that, I don't know if he's in the group, I don't think so, but he was told that, oh, we'll go into it on Thursday, but the one who asked if we offer reverse mortgages. So, anyway, the way a reverse mortgage works is that, first of all, there's two types. You could do a reverse mortgage as a refinance, cash out. It would be a cash out. So you can do a refinance, or you can actually do a purchase. So that sounds confusing. How do you do a purchase? Reverse mortgage. So first of all, I'll get the purchase out of the way since it's kind of easier to explain. So in a scenario, let's say you have your 62 or over borrower who owns a home. He wants to sell that home. Let's say he owns it free and clear because he's retired, but he wants to move to another home. So then using the proceeds from that home, he would have to put a down payment on the new home, and the balance he would get a reverse mortgage in which they don't have to make any payments on it. Sounds like a good plan, doesn't it? So that way you could either upgrade or downgrade to whatever you want to move. But
you just need to be 60 years old.
62.
62.
62 or over. So 62 or over, you could move and then not worry about having a mortgage. Now here's the thing. The down payment is large. Okay, it's not your normal FHA 3.5% down. Even though the reverse mortgages that we work with our investors, these are all insured by FHA. Okay, so but because they're insured by FHA, but it doesn't mean that we're going to have the same loan to value. It's still a very low loan to value. That formula I do not have, but that's why we have to submit the quote. And I believe it's an algorithm they use. It's based on the factors they use to determine your loan to value is going to be your age mainly, because based on your age they have a life expectancy, like how long that you're expected to keep that mortgage before, because this mortgage does not have to be repaid until the person, what they call it, they leave the property. So until they leave the property, whether it be by involuntarily or voluntarily. Okay, so when they leave the property, now the mortgage, they have about 3 months to repay the mortgage. So
let's say if they go into a convalescent hospital where they have to be taken care of for nurses, Then you have to pay it off.
then the loan would be due. Yeah. In case you guys didn't hear, in case the person can no longer live in the home and take care of themselves or the house, and they have to go into a convalescent home, then well, first of all, if it's a couple, I mean, and only one of them leaves, that's okay, as long as one of the borrowers stays in the property. But if all of the borrowers on the loan leave the property, then the loan is due and payable, and they give you 3 months, I believe 90 days. I don't think it's written in stone, but it's generally three months to either refinance or sell the property. So that's one way that the loan gets paid off, leaving voluntarily or involuntarily. So loan is due. Oh, so no, espérate.
If there's a married couple and one is younger than 62, it's okay.
That's fine. Yes, that's fine. You could have I was gonna say young girl marry a sugar daddy, but no. She could stay in the property. No, but that I don't know. Like I said, that all goes into an algorithm, so it's based on like I said, their age.
But as long as one is over 62.
As long as one is 62 and they would qualify, yes. The spouse does not necessarily have to be 62. It could be under 62. Okay, so again, the algorithm is based on the combination of the person's age and the interest rates, believe it or not. Okay, interest rates. Because we've noticed in the last 2 years the loan to value has gone down, and I'll go into like there. Well, might as well. I'll tell you right now. Let's just say this is the total value of your property, so you could visualize it. A couple years ago they went up to like but almost 50% of your value, so 50% loan value. But right now they're about, I don't know, what is this? 44%. Okay, based on the interest rate. A couple years ago they were at 40. We got one. Actually, they didn't close, but they were quoted at 49%. Now the last quote we did, one was at 41%. The highest I've seen is 44%. Of course. Naturally, me being curious, I asked them, well, why the change? And they say it has to do with the interest rates. These loans are, you have a choice, either fixed rate or adjustable rate loans. The fixed rate loans, you have an even lower loan to value than this, which to me doesn't make any sense, but and the adjustables have a higher loan to value. And for some reason, it offers like more opportunity for us to make a commission on them. So we choose the adjustable loans, which, like I said, to the borrower, it doesn't really matter. They're not going to be making payments, so it really shouldn't matter whether they get a fixed rate loan or a adjustable loan. But here's about where you're going to be. So in the example that I used earlier, somebody with a purchase, so you sell your property, you have let's say you have $300,000 down, you want to buy a $500,000 home, that would be doable. Put you 300 and 200. The 200, as long as it falls within the 44% of your loan to value, then you have a loan that in which you're not going to be making payments for the rest of your life. Okay.
So what Pulido is trying to say is that the equity that they're going to ask you, so there's no specific rule. So let me translate, pinche Pulido. So there's no specific rule as far as the LTV that they're going to ask you. Basically, what Pulido is saying is that the LTV that they're going to ask you depends a lot on the interest rates, depends a lot on your age, and depends a lot whether it's fixed or variable. Continue to the next
There you go.
slide.
There you go. Oh, you said to take my time. It's called. That's a reverse mortgage. They're called HECMs. So, stands for home equity conversion mortgage. Which means that in itself, it's you're converting your equity into a mortgage. That's what it is. HECM. So on your HECM loans, sorry, Oscar. I know Oscar wants me to go real fast so we can finish fast, but since I don't even know if the Zoom people are alive, you know, they're still there. Oh, look at that. Ya se llenaron.
Si yo soy cantista, estaban tres caras.
Espérate, so, okay, so again, let's go. The only thing we need for our HECM loans is, again, if you're 62, mortgage or no mortgage, whatever, we can get you a quote. No, I don't have a formula. We just input into the system, and based on their algorithm, they tell us, yeah, this is what you qualify for. Basically, that's it. The amount. Now, if here's all the qualifications. If you have, because Oscar also mentioned FICO, they really don't care much about FICO as much as they care about derogatory credit on your credit report. So if there is derogatory credit, like in the last 2 years, meaning like collections, charge-offs or stuff like that, they will implement what's called they'll get Lisa involved. Okay? So Lisa is basically like your escrow account. This is life expectancy set aside. So if you have derogatory credit, they're going to take a portion of your loan proceeds and set it aside, and that portion is huge. It's not like it's not like a regular loan that they're going to take 3 or 6 months, you know, or 9 months like in our mortgages for taxes and insurance. They're going to take that times your life expectancy. So that could be a huge amount. That could be $50,000 to $100,000 of your proceeds that they're going to keep. Let's say you have a $500,000 property. Okay. From this, 40% you're going to get a loan amount. Approximately $200,000. Okay.
That is what you owe.
That, yeah. Let's say the value of your property. This is your appraised value. So appraised value, 500,000. This they will make a loan of 200,000.
Okay.
Okay. Now, how much of this 200 are you going to keep? That's pretty much it. I mean, basically their credit
Uh-huh.
and income. They will want to know. Do you have any type of income? You're retired, just enough so you can cover your taxes, your insurance, and of course if you have any other outstanding liabilities.
Okay, so that is important also.
Yes.
Uh-huh.
So-
What about family members? If I passed away, do I need to involve family members?
Mm-hmm.
Uh-huh.
No, what in the application process that the borrower is required to fill out information about their family members, like an alternate contact other than themselves. So it's not just so the lender knows that well, we can't get a hold of the borrower. There's someone else that we can contact.
¿Tienes una pregunta, Juan? Juan, we cannot hear you.
Juan, it's me.
Uh-huh.
It's not Juan, it's me.
Question.
Yes.
Well, you are talking about they have to have an income to cover taxes and insurance and also any liability they have.
Right.
What about if they have like a regular, when we do a regular refi cash out and they have liabilities, they can pay out from the cash out on the reverse mortgage?
Yes. Yes, you can pay off the liabilities. Correct.
Okay.
With the proceeds. So and they do take another thing, a last thing into account, what's called I don't know, based on your poverty level and the number of people that are living in the house.
Pulido,
A ese sí lo escucho. ¿Qué pasó?
any ratio to cover the tax insurance? So it's, for example, the tax insurance is like 1,000, and the people make 1,000 in retire, we're okay.
There is no ratio, but there is a minimum income that has to be left over based on your family size. Okay? So very good question. Like I say, yeah, if you have $1,000 in Social Security and $1,000 in liability in tax insurance and credit cards, then no, there's not going to be enough. Then in that case, they will implement the lisa on you. Okay?
Pulido, if they are 52 years old, what kind of size of family? Pulido, come on.
What kind of what? Huh?
Size of family, you say.
What type of family?
Size.
Size.
So
Look at me.
in the VA loan, basically if you buy a house that is too big, the VA loan assumes that you're gonna spend more money in utility bills. So the VA loan works that way also. So they work by ratios and they work about the size of the house. The bigger the house, the more expenses. The bigger the family, the more expenses. So if your parents are living with you, you have kids living with you, dependents living on you, then the VA makes a calculation of what they call residual income. So what Pulido is saying over here is there is no ratio, but yeah, the size of the family becomes an issue. Obviously, Luis, you're saying, well, there are 62. I mean, they probably don't have a size of the family. But there could be a family that they live with the kids there and they live with the grandkids. So if that's the case, then the size of the family plays a part, and you have to have residual income to cover that. Make sense? So and it's minimum, it's not too high. So there's no ratio involved as long as you can cover your taxes, your liability, your insurance, and you have a little bit residual income to live.
Does the family size count what is on their taxes or who actually lives, like how much you disclose they lives in the house?
It's disclose how many they live in the house in the questionnaire.
Okay. So
Make sense or not, Sue?
okay. So anyway, now that we have that out of the way, so like I said, no ratios, but yeah, residual income is, you have to have at least the minimum residual income based on family size. And I believe for 2 people in a house, it's, I think it's about just under $1,000 a month, so of residual income that's supposed to be left over. But anyway, it's not like, they're not gonna necessarily turn you down because you don't qualify because of the ratio, but you're just gonna get less money available because they're gonna put that, the LISA, the fund set aside to cover so a scenario would look like this. How much, because this is important to know, especially for a commission. Let's say if you have $500,000 house, your max loan amount is going to be $200,000. Let's say about $25,000 go into closing costs. Okay, so then you have $175,000. Out of that $175,000, the borrower is not going to receive that in one check. It used to be like that at one point. They used to have, but I believe right now, even if they consider it like a one lump sum, they still will not receive 100% of the proceeds. They divide them. They will only give you 60% of the $175,000 the first year. After the first year, then you get the rest. But the advantage of it is for the borrower is that in 1 year from now, after to get the additional funds, if their property went up in value, then this will go. So they'll have more money available. So, and they will keep offering more funds because we did one, and the borrower keeps getting letters every month. This is how much is available to you this month. All you have to do is sign here and tell us the amount that you want, and it's in the bank within 5 business days.
For that scenario, it will be a cash out scenario.
That would be on a refinance.
Refinance
Correct.
cash out.
And I'm not sure, quote me on it, but if it was a purchase, same thing, because if the initial, it would be the same rule. If the property's going up in value, then they're gonna have those funds available to you. But remember that for us, it's important to know because we're gonna get a commission based on the first disbursement only. Okay, we're not gonna get a commission based off of 200. Okay, so 200. So the first disbursement, so let's say round it up, is gonna be like 100,000 in this case. So that's your commission. And after the first year, I would love to call the bank and say, hey, my borrower just got the rest of the funds. Where's my commission? But it doesn't work that way. So that's the only drawback for us. But like I said, it does for the borrower. They initially they have this available, but it does change as long as properties keep going up in value, then and as long as their total loan amount, because every month, remember this thing is going up because of interest every month. So this in 1 year is going to be 220,000 approximately, but if this went up to 600,000, so they're going to have money available, right? Because the
So, okay, and in that scenario, Pulido, it is a cash out refi. If he's gonna get up to 100,000, you're gonna get a commission only under 60%, like
Yes.
100,000 only?
under initial disbursement, yes.
Oh,
Which, I mean, I'm running it off, it's gonna be about 120,000, something.
okay.
Yeah. So,
Okay.
yeah, that's the only bad thing for it. But, I believe, like I said at the beginning, we are allowed to charge more than 2 points. And just like, on our loans right here, I mean, it's not, it doesn't necessarily reflect on the closing statement. The closing statement will reflect $6,000 origination fee, which we charge. So we do have the origination fee plus the discount points.
Okay.
Or not discount points, I'm sorry, but rebate back to us. Okay, so at this point, I don't know, I believe I covered everything. Unless anyone has any questions.
So any
To
questions,
recap?
Sumers? What about Pulido, the family members? So do you get involved in the loan, the family members, or is just an explanation that you need to gather the whole family and tell them what are you
Well,
doing?
let me just tell them real quick.
Real quick?
Real quick.
Is that not a good question and answer?
No, pues si no me preguntan, a ver. Okay, so initially, before you can even, the bank will accept an application, the borrower needs to go through what's called counseling, mandatory counseling. And in that counseling, they do encourage, like Oscar said, family members to join in, so everybody knows what, they will explain to the client, and once the borrower fully understands what they're getting into, then we can submit the application. But as far as like mandatory family, there is no there is no requisite. Like I said, they do want you to list someone other than yourself on the application, and it's in the disclosure package. So they do need, and they do contact the borrower I don't know if it's every month or every couple of months, just to make sure they're still here. So.
Any
Okay.
questions, Sumers?
One question, Pulido. For example, in the scenario, my mom lives in the house, she do that, and then my, for example, the grandchild wants to live with her, okay, and they want to pay off the loan. It's gonna be like a penalty for pay off.
No prepayment. You can tell them.
You can
no prepayment.
refinance to release.
No prepayment penalty.
You
And
can pay it off whenever you want.
Like the grandchild is gonna be living there, so and they have income and everything, he can do refinancing.
Yes.
Yes.
You could always go back and do a regular refinance from a reverse. Let's say you change your minds, they want to start making payments again. You could, but now they have to qualify. Whoever's
Yes, I know.
same rules as a regular loan, but
Thank
no
you.
prepayment.
Any other questions? So reverse mortgage is obviously, you're consuming the equity of the property. You're consuming the equity of the property, and sometimes, like Cecilia just mentioned, when you have family members or you have a grandkid, they're saying, no, you're consuming the equity of the property, and granddad, I don't want you to consume the equity of the property because you told me that you were gonna leave the property to me. So if you're consuming the equity of the property, then you're not gonna leave me anything. I mean, you can run into family members that have that mentality. But the contrary of this is, okay, well, don't consume the equity of the property, but you need to help your grandparents. So I'm dealing with the same case with my parents. I believe if you talk to Maria, she's dealing with the same things with her parents. Some of you, I talk to you, and you're dealing with the same thing with your parents. That I mean, we have to cover their expenses. We have to cover whether it's care of them. We have to cover medical expenses. We have to cover living expenses. And in the case of in my case, for example, let's just pretend that I don't have the means to help my parents. They have a house in Mexico. Let's just pretend that the house is here in the United States and it's fully paid off. Well, do I care about the property? Do I care about the policy, or do I care about helping them right now? If I can create a reverse mortgage on a property that is fully paid, and they will receive $1,000 or $1,500 every month, I'd much rather have that than me just giving them $1,000 every month, and I don't have the means to do that. I mean, I already have my family, I already have kids in college and everything, and I can't help my parents, so the property can help them, and that's the whole purpose of the loan. For them to save money, for them to cover some of the expenses, and not to put the burden on the kids. Yes, the equity is running out, but it's either the equity runs out or somebody needs to help the parents. That's the bottom line. Questions, comments?